wealth strategies on active and passive investments, and what works for you better. Even if you selected to be an investor, you may be a passive or active investor. It depends on the amount of time you want to involve and adequate knowledge to run the investments by yourself. You may start with passive investments first, then build on the foundation of passive investments to become an active investor. You may be an active investor in an area you know well like stocks and a passive investor in some other area like real estate. A passive investment strategy is good for people with busy lives, families, jobs, outside interests, or entrepreneurs building businesses. Their lives are already full, leaving little time for developing investment skills despite its financial importance. A common result of this time limitation is passive investors often delegate their responsibility and authority for their investment decisions to financial planners, brokers or money managers. Rather than becoming experts in investing, passive investors typically rely on other people's expertise for their investment strategy. The defining characteristic of passive investment strategies is their simplicity. They require less knowledge and skill, making them accessible to the general public. Buy and hold with mutual funds or stocks, financial commodities allocation, and buying real estate at retail prices are all examples of passive investment strategies. There is nothing wrong with any of these strategies, they just have consequences. You can become very wealthy given enough time, discipline, and regular contributions to an investment portfolio following the passive investment style, but you will take a lot more risk and can expect lower returns than investors who have reached the next level of investing. The problem with passive investing is the lack of added value based on the skill of the investor to the return equation and the little control over your financial security because it lacks the necessary risk control strategies unless you have great skills. Passive investors are dependent on the opportunity in the market for returns. Rising markets provide great returns, and declining markets provide miserable returns. While passive investing is not without its flaws, for many the advantages outweigh the disadvantages, making it the right course of action. Passive investing is far superior to not investing at all because it starts the process of compounding returns on invested capital with the lowest amount of time and knowledge required.